Welcome to Study Session 9, Feasibility Studies Part 4, Introduction. This unit concludes the discussion of feasibility study with explanations on the rest components of feasibility study. These include the management and organization studies, financial projection, financial analysis, sensitivity analysis, the economic analysis, and viability report. The management and organization studies. The management and organization studies are a dynamic survey which is carried out to collect information about the labor requirement, the site requirement, and the overall organizational structure of the firm. It deals with decision-making, planning, and implementation strategies that ensure maximum profits. To ensure the success of any project, proper attention must be given to the importance of management. No matter how good the market prospect, how sound the financial structure, or how outstanding the engineering network, every project will ultimately succeed or fail on the strength of its management structure. The management structure deals with how each section or department is related to the other, such that inward and outward linkages exist to provide for a coherent and systematic operation. To ensure effective management, certain details about the structure of the organization have to be provided. These include 1. The design of the organizational structure. Is it going to be hierarchical, line and staff, functional, and so on? 2. Specification of responsibilities. To avoid chaos and wrangling over one's territory of responsibility, specific responsibilities have to be spelled out for specific positions. 3. Qualifications of the personnel. Having spelled out specific qualifications for those to occupy positions of responsibilities, qualifications should be spelled out. 4. Personnel training program. It is important to develop, even at the initial stage, some employee training program designs to meet the needs of the organization. Financial projection. This aspect deals with the cost and benefits analysis of a project and analyzes the financial profitability of the project. This is required in order to justify the viability of the proposed investments. The projections, which should cover a period of at least 5 years, should cover the following. 1. Review of the completeness and accuracy of fixed investment. Project cost estimate may not be exact, but efforts should be made to avoid underestimation. The accuracy of the whole analysis depends on how good the estimation is carried out. Some of the items of fixed costs include A. Advanced expenditure. For example, investigation and explanatory missions, technical, economic, and market research requirement, and feasibility studies, engineering advice, draft of preliminary plans, financial inquiry expenses, and legal hires. B. Land and land improvement, payment for land, legal expenses and taxes, reclamation and drainage costs, access roads, clearing and filling expenses, and so on. C. Building and site facilities. These include expenses on building in rents, well or reservoir usage, fencing, electrical and electricity installation, and so on. D. Machinery and equipment. These include the acquisition and installation of machinery and equipment, office equipment, vehicle or distributing vans, and so on. Attached to these are the custom duties, court fees, cost of insurance, custom clearance, cost of handling and transportation to the site and storing during engine installation. E. Spare parts for machine, vehicle and office equipment. F. Consulting services expenses. G. Cost of intangible items, for example, patents and licenses. H. Preliminary expenses, for example, cost of incorporating the company, raising capital, advertisement, training of employees, and so on. I. Contingency allowance. 2. Estimate of the working capital. Working capital is the amount of money required to finance all the current assets, such as raw materials, spare parts, semi-finished and finished goods, accounts receivable, repayments, and cash. The net working capital will be current assets minus current liabilities. The current liabilities are the bank loans, overdraft, and credit given by the suppliers. The total working capital depends on operating costs, volume of production, length of production cycle, policy regarding account receivable, trade credit, type and nature of production. The working capital is usually estimated for a month under certain assumptions. 1. Raw materials also remain in stock for 1 month before production begins. 2. Production takes a month. 3. Goods remain in stock for 1 month before they are sold. 4. Consumers are given 1 month credit. 3. Review of completeness and accuracy of the operating costs. The items under the operating costs include cost of direct material, cost of direct labor, overhead costs. 1. Direct materials. These are materials which become an integral part of a company's finished product, such as materials, foils, workshop supplies like glue, office supplies like staple pins, parking materials, and so on. 2. Direct labor. This refers to the services of employees who work directly on the product being manufactured. For example, operators, factory workers like painters. The direct labor cost is the payroll of all employees directly involved in the production of the goods. 3. Overhead. This refers to the cost of all inputs used in manufacturing process except direct materials and direct labor, that is, all indirect labor. Factory overhead are measured by including all costs of indirect materials such as lubricant, first aid suppliers, and cost of indirect labor such as engineering supervision, maintenance labor, and so on. The items under each of the operating costs can be outlined as follows. 1. Direct materials. Raw materials, fuels, maintenance materials, workshop supplies, and office supplies, parking materials, and so on. 2. Direct labor. Wages and salaries, allowances, commission, directors' fees, and so on. 3. Overhead. A. Indirect labor, that is, factory engineers, material handlers, factory supervisors, security men, and messengers. B. Worker compensation insurance. C. Pension plan costs. D. Indirect materials, that is, supplies used in the factory, lubricants, first aid supplies, cleaning supplies, maintenance parts, small tools. E. Depreciation of buildings, machinery, and equipment. F. Taxes and insurance on factory building and machinery. G. Rent of a factory building. H. Factory electricity and telephone expenses. I. Selling and distributing expenses. Research and development. K. General administration. 4. Estimate of revenue. Revenue is computed as price multiplied by the unit of product sold. We have to justify assumption about the price of the product and the amount of sales if accurate revenue were to be computed. Financial analysis. 3 specific accounting analyses are required for financial analysis. 1. Income statement. 2. Flow of funds statement. 3. The balance sheet. Usually, a 5-year projection is made for comprehensive and useful financial analysis. When a company is newly set up, it would rely solely on projections, but when the existing one is to increase operation, the forecast has to be reconciled with the actual financial analysis. Sensitivity analysis. Sensitivity analysis deals with possible changes that can occur during the implementation stage of the project. Examples are changes in income level, taste and preference of consumers, government regulations, and so on. As a result of possible changes in these economic variables, it is necessary to carry out sensitivity analysis to reflect their effects on the cost and benefits of the project. A project that is viable at the time of preparation might turn to become unviable if the vital economic variable mentioned above change in negative way and vice versa. The economic analysis and viability report. In project analysis, the viability report is very crucial. This deals with the profitability of the project. The profitability of the project is measured by using the various investment criteria techniques such as net present value, NPV, internal rate of returns, IRR, and payback period. A project is declared viable if the NPV is greater than 0 or if the IRR is greater than the market rate of interest on loans and the payback period is short. This shall be discussed in details in Chapter 5. The economic benefits of the project should also be analyzed. This includes the impact of the project on provision of infrastructure such as electricity, pipe-borne water, telecommunication, network, good road, and so on, as well as the employment generation capacity of the project. This is the end of study session 9. Thank you.